This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Strong finish. Stocks take off to close the week. The Dow gains more than 200 points. Why? Well, some think the longtime market antagonist, oil, may have hit a bottom.
Quite a fall. One of the towns that reaped the rewards of the oil boom is now feeling the pain. We'll take you there.
And this week's Market Monitor says you should own this stock, which he says could nearly double in the next year. He'll tell us what it is. All that and more for Friday, March 11th.
Good evening, everyone, and welcome. Stocks closed out the week on a strong note, surging more than 1% to 4 straight weeks of gains. That's the first such surge since November. Now, the catalyst, well, some pinned it on investors taking a more optimistic view of yesterday's moves by the European Central Bank to cut rates and expand its stimulus program. Others, by contrast, say it was a report that helped lift oil to its highest price since December. More on that in a moment. Well, whichever one you choose, it was a good day for stocks. The Dow rose 218 points to 17,213. The Nasdaq gained 86. The S&P 500 rose a big 32. As for the week, the Dow and S&P added roughly 1%. The Nasdaq a little less than that.
Oil got that lift today following a report by the International Energy Agency, which said that prices may have hit a bottom. As a result, domestic crude finished up nearly 2% to $38.50 a barrel. That's the highest level since December and a 7% gain for the week. Jackie DeAngelis tells us what the IEA sees.
The million-dollar question for oil: have prices bottomed? The International Energy Agency said today it's possible. The IEA's most recent report, citing reduced output in the United States and from other non-OPEC producers as one reason supply and demand should begin to come back in line. It also said Iranian output hasn't been as dramatic as believed before. In fact, here in the United States, the agency expects production will decline this year by more than 500,000 barrels per day. It also said OPEC pumped 90,000 less barrels per day last month. All positive signs that will support oil prices. But it's not just the IEA report influencing prices, it's also seasonality.
Usually around starting Memorial Day is where we let's say have our climax here, and to see if the market really is, a strong usage market. Again, I can't foresee it yet. I think it's going to be a big driving season, and I do see the prices holding firm.
$40 is a key psychological level for oil prices. We're edging closer and closer. But does this rally have legs to break through and hold?
In crude oil, I would think we're talking about $36 to about $42 near term. I think with, let's say, a very strong driving season, we could work our way probably to the high 40s.
Still, last year we saw a similar bounce in oil prices in the early spring. But in late June, prices dropped dramatically again. The concern right now is the recent rise in price might actually encourage more production, which would only depress prices once again.
I don't think this is a market that's a runaway bull market by any means. There's a lot of inventory out there, and there's going to be, let's say, a moderate growth here, let's say, in the price over the next 3 to 6 months, which would make perfect sense here.
Another risk to the downside, the dollar. Relatively quiet for now, but another move higher could hit commodities. For Nightly Business Report, I'm Jackie DeAngelis.
When oil prices were booming, one of the states that benefited the most was North Dakota. It was awash in cash, and in its budget, it more than tripled to $6 billion since 2007. But now, after the fall in oil prices, North Dakota has become a state of pain with a budget shortfall and a governor looking for cuts to save money. Brian Sullivan is in the town emblematic of the highs and lows, Williston, North Dakota.
No town in America may have benefited more from oil's boom than Williston, North Dakota. But now, no town in America may be feeling the hit from oil's collapse as much either. Those who came here from all over America looking for a job are now going back home. The work just simply isn't there, as overproduction has forced the number of new wells being drilled to dry up. We went out to one of the few remaining oil rigs and spoke with its manager about what's happening to the workers.
The problem is you lost the crews that you just trained up, right? Those guys are now gone, and that's the problem with the down cycle is you lose all your talented people, and now you got to retool, respool, you got to retrain.
During the peak of the oil boom, tens of thousands of workers came to North Dakota. Most of them lived in what they call a man camp. The nice word is hotel. Basically, 1,000+ workers all living in dormitory-style arrangements with a big master hall. This was pretty much considered the cream of the crop, the best one, the Capitol Lodge. At its peak, 1,200 workers, 3 hots and a cot every single day. This was the main hangout, TV, blackjack, workout room. Now it sits empty as oil slump has caused the workers to go back home. By the way, this $40 million facility is now up for sale. It can be yours. It's not just the oil industry jobs that are being lost either. All the businesses that grew to support the once booming industry are also taking a hit, hotels and restaurants in particular. How severe has the downturn been for you and for the town?
Well, for us, our business from a top-line revenue standpoint is down 50%. And it varies week to week, but every week it keeps getting worse. So we don't know where the bottom is. We're not there yet.
Williston may be located hard up against the banks of the Missouri River, but it is oil that really flows through this town. And nearly everyone we spoke with here said that if the price of crude doesn't move back to $50 or $60 a barrel sometime soon, the economic miracle that was the black gold rush may turn into a bust. For Nightly Business Report in Williston, North Dakota, I'm Brian Sullivan.
Despite the rally in gold and oil prices, I should say, our next guest says he doesn't believe the oil market has reached a bottom. Joining us is John Kilda, founding partner at Again Capital, and he joins us now to make the case for why he thinks we could still test that $18 mark, which you predicted on our show. You know, I slipped and I said gold because it is this is being likened to the gold rush, right, John?
Oh, absolutely. That story that Brian Sullivan just reported, 100%. Classic American boom-bust story.
So why do you think that $18 may still be in the card? You don't feel the bottom in this market yet?
No, because really nothing has changed materially in terms of supplies. For all the talk of OPEC getting together with Russia, there's really strident discord among those participants. There was supposed to be a meeting on March 20th. I don't even think that's going to come together at this point. And when that deal, this freeze deal that they've touted out there falls apart, Sue, I think that the market's going to punish them for all this rhetoric.
We've seen oil go up and down violently, now up about 40-some% from those lows back a month or so ago. How much of that, if any of it, is fundamental that has changed? I think a lot of it's short covering.
It's been a big short covering rally. Also, too, a lot of bargain hunters came into this market and have bought it up. We've seen a lot of speculators come in from the long side of the market, not just short covering, but also a wave of money from the long
market
side.
Can, forgive me, Sue, the market can defy fundamentals, but only for so long.
That's right, but for a while, and can really put some pain on you if that's all you're banking on. The other thing I'm figuring in here on this call still is that the economic data has not been great. So the demand side of this equation is slipping as well, which is why you saw such massive action by the European Central Bank this week. And we'll see more of it next week from the Bank of Japan. So slowdowns in Asia, slowdowns in Europe, and no end to the supply glut just equals lower prices for me, not higher.
So that's going to be, you know, I wondered whether it was going to be an external shock, perhaps, that would take the market back down to your target. But it sounds like it's what we already know that's out there. A weak global economy, our Fed on a raising trajectory, the rest of the world on an easing trajectory, and those are the fundamentals that the market will wake up to once again.
That's right, an easing trajectory in response to bad facts on the ground. We had a bad week from China in terms of data this week, except for their inflation, but the import-export numbers were terrible, and they too are stepping up to the plate to try to do something to spur their economy. And the oil market needs that demand from China to stay up around even here and to stabilize. So that's what we're focusing on.
So you're highly skeptical that there will be any sort of production cap?
Oh, I don't believe it for a second. The Saudis are intent.
Let alone a cut.
Let alone a cut. No, because the deal breaker is going to be from Iran. Iran said again just today that they will not agree to a freeze until they get their market share back. And that's the rub for this whole thing. That's how the Saudis have set this up so beautifully, to say, sure, we'll go along. We'll cooperate with everyone. And as long as everyone agrees to a freeze, we'll agree to a freeze.
And not
everyone's going to agree to a freeze. We know that for a fact.
Interesting. Such an interesting story. John, thank you very much. Have a great weekend.
You too now.
Alrighty, now to a story that hits very close to home for many who commute to work. New Jersey Transit, the third busiest commuter rail line in the country, is on the verge of striking for the first time in more than 3 decades. A disruption would hit more than 100,000 commuters who work in New York City and thereabouts. At stake, unions want a double-digit wage increase and lower out-of-pocket health care contributions. The agency that governs NJ Transit argues that that would cost an additional $183 million annually. That would mean fare increases. But as Morgan Brennan tells us, while the argument may be local, it has much bigger implications.
More than 4,000 New Jersey Transit rail workers could walk off the job as soon as Sunday morning if a labor dispute isn't resolved, affecting travel in America's biggest metro area.
New Jersey Transit remains committed.
New Jersey Transit has contingency plans in place, but they cover less than 40% of the state-operated carrier's Big Apple commuters. The reason officials warn that an additional 10,000 vehicles could hit the road at peak hours, creating bottlenecks stretching up to 25 miles long. Business advocacy group Partnership for New York estimates a strike could cost New York City businesses nearly $6 million per hour in lost productivity, particularly in the finance sector or Wall Street. Major employers are planning for the worst. Citigroup, for one, has said it will modify employee hours and encourage telecommuting if necessary. And a strike could also affect freight railroads that use New Jersey Transit's track, causing diversions or possibly even service interruptions. Norfolk Southern isn't commenting, and CSX says it doesn't, quote, anticipate significant operational impacts, but is monitoring the situation. It all speaks to a larger issue affecting New Jersey, as well as other states and local governments, a shortfall in transportation funding. Many are struggling to fix budget deficits, facing difficult decisions to raise fares and address ballooning spending, including labor costs. In New Jersey, talks continue as both sides scramble to reach a deal, but there is one person notably absent. Governor Chris Christie, who after dropping out of the GOP race for president, has been on vacation, though reportedly keeping tabs on the situation from afar. For Nightly Business Report, I'm Morgan Brennan.
And coming up, this week's Market Monitor thinks the market will still turn in gains by the end of the year, and he has 3 names he thinks will help your portfolio get there too. Last year was a strong one for commercial real estate, but there are cracks forming in that sector. And as Diana Olick tells us, some of the trouble has a familiar ring to it.
2015 was a banner year for big buildings across the nation. Commercial real estate vacancies were low and rents ran high. Loans for commercial development were also big, but what a difference a few months make.
There's been a really interesting shift in the capital markets writ large across not just commercial real estate debt in the public markets, but also high yield debt. And what we've seen there is the beginning of this year, the spreads blowing out.
Investors are demanding bigger yields, and commercial loan debt isn't doing it for them anymore. This debt, called CMBS, is bonds backed by buildings. It is the second largest form of financing behind the big banks, and here's the issue. 10 years ago, we also had a commercial real estate boom, and a lot of it was backed by CMBS. Those bonds have a 10-year lifespan and have to be refinanced now.
We think some of these are going to be remonetized through sales, through asset sales, but some will certainly hit the foreclosure list and end up on the special servicers list of loans to be worked out.
CBRE estimates at least $43 billion in loans could face trouble this year and next, with secondary markets like Kansas City, Cleveland, Minneapolis, Jacksonville, and Hartford hit hardest. Yes, banks could step in, but they're getting hit with a lot of new regulations this year that are making them more skittish about real estate.
There are other rules coming out on general debt that are going to be affecting appetites from banks, from the CMBS market, from others to provide capital. That could affect availability. It could also affect pricing of some of those loans.
On top of that, commercial real estate prices fell in January for the first time in 7 years, according to Moody's. And that is not going to make investors feel any better about the sector. For Nightly Business Report, I'm Diana Olick in Washington.
General Motors gets serious about the self-driving car market, and that's where we begin tonight's market focus. The carmaker bought Cruise Automation, a software company focused on creating those driverless cars. General Motors did not disclose how much it paid for the startup, but the transaction reportedly worth more than $1 billion. Shares of GM up about 1.5% today to 31.26. Ligand Pharmaceuticals got a bump up today after the investment banking firm Roth Capital increased its price target to $147 a share on the drug maker. Earlier this week, the company's CEO sold over 10,000 shares of company stock. Those shares were up nearly 5% to $101.83. According to a late-stage trial, Regeneron Pharmaceuticals' experimental rheumatoid arthritis drug has proven to be more effective in treating symptoms of the disease than rival AbbVie's medication. Nevertheless, shares of Regeneron fell fractionally today to $377.12.
Investors had their chance to react to Bojangles' earnings, which came out after the bell yesterday, and boy, did they ever react. The fast food chain's profit fell as poor weather drew in fewer customers, but the company still managed to top street estimates on both earnings and revenue targets. Those shares soared more than 23.5% to $18.57. The People's Counsel for the District of Columbia has weighed in and said that she opposes the latest merger proposal between energy companies Pepco Holdings and Exelon. Now, the council cited unguaranteed rate protection as the reason. She is one of several city officials who have to approve that deal. District regulators have rejected the merger twice, and D.C. is the only area in the Mid-Atlantic not to approve the deal. Shares of Pepco fell 9% to $22.07. Exelon was unchanged at $34.73.
And now to our market monitor, who's expecting one of his stock picks to rise nearly 50% over the next year. This is his first time joining us on the program. He's Michael Binger, Senior Portfolio Manager with Gradient Investments. Michael, welcome. Good to have you with us. If all of your stocks go up 50% over the next year, you can come back, okay? How about that? That's a deal.
Thank you very much. Life would be easy then, wouldn't it?
Yeah, it would be very easy, and I'll send you all my money. What do you see for the market between now and year end? It's come back very nicely in the past few weeks. My sense is that now we got to see some profits.
Well, we do. Let's think about it. So earlier in the year when oil was, let's face it, it was crashing and interest rates were going back down towards 1.5%. I mean, people were interpreting that as we're going into recession. But the economic data didn't support that. In fact, the economic data was pretty good, especially the consumer spending and consumer sentiment data. So it looks like the recession is off the table. Oil has now come back a lot, and interest rates are moving up a little bit in anticipation of growth. So I see positive returns for the market this year. Like you said, the wild card is earnings. We need to see earnings growth, and we think the third and fourth quarter, the back half of 16, earnings will begin to grow again.
You've given us three stocks to talk about, and there is a general theme to them, and that is dividends and value. So let's start with your first pick, General Motors, and they've had some good quarters.
They have. They've had fantastic quarters. And auto sales in the U.S. are hitting record highs. But there's this pervasive fear in the market that we're hitting the top or the peak. I don't think we are. The company says we're not. I think sales will continue to be strong in the U.S. and globally. This stock pays a dividend yield that's right around 5%. It's cheap at 5 or 6 times earnings. I think it's a steal here.
They've got some very stylish cars coming on, too. The Impala, a couple of the Buicks, the Cadillac as well. Let's go to your second pick, which is Omega Healthcare. Healthcare investors. You say that it's kind of being tarred with a broad brush.
I believe it is. So Omega is a healthcare property REIT, which means they buy properties and then they lease them to healthcare providers. So I think they have a great demographic tailwind behind them. You know, none of us are getting any younger, and we're going to need more and more healthcare as we get older. This company executes outstanding. It has a 6% plus yield. There's a competitor of theirs that has had a problem with one of their tenants, that's Manicare, who Omega has no exposure to. And I think at a 6% yield, a company that's executed flawlessly and its fundamentals are great and the stock is cheap, it's a buy too.
All right. The last name I think might be controversial to some. It's Twitter. Because there have been those who have forecast Twitter's demise. But this is the stock that you think could be close to 50% higher. Tell me why.
Okay, so this, you're right, this is a battleground stock. It's in the social media area. I think investors are kind of overlooking the fact that this company is still growing its top line over 30% on a year-over-year basis. On top of that, they're doing it profitably. Now, the market wants to be focused on this metric called MAU, or monthly average user growth, which has come down a lot to almost zero. But I think the company has rededicated themselves to fixing that, to make it more user-friendly, to make Twitter expand. I think it's going to grow again, and as soon as it does, as soon as investors see that, I think the stock is in the 20s.
All right, Michael, thank you.
On its way to 30.
Fantastic. Michael, thank you very much. Michael Binger with Gradient Investments.
Coming up, how a new rule is making brokerages rethink how they advise you on your retirement plans.
Here's a look at what to watch next week. On Tuesday, we'll get a read on inflation at the wholesale level with the release of the so-called producer price index. Wednesday, we bring inflation back to our level, the consumer price index. Inflation, of course, a key component on the Federal Reserve's watch list with respect to interest rates. And speaking of the Fed, the central bank will wrap up its two-day policy meeting Wednesday with Chair Janet Yellen holding a news conference. That's what to watch next week.
A new rule expected to be finalized by the Department of Labor in the coming weeks may impact millions of investors with retirement accounts, along with the brokers and the other firms that manage those monies. It's designed to prevent financial advisors from putting a client's retirement savings into high-priced products, benefiting the advisor's wallet more than the investor's. And the rule will rewrite how trillions of dollars of retirement money is managed. Mary Thompson takes a look at who wins and who loses when that rule comes down.
United in their support of acting in a client's best interest, the Department of Labor and the financial industry disagree on whether a pending rule helps, as the Labor Department says it will, to protect investors from backdoor payments and hidden fees in retirement investment advice. The securities industry trade group SIFMA counters this rule will hurt investors.
It's going to limit investors' choice, and it's going to raise their cost.
The rule requires brokers and firms providing investors advice on how to invest or move their retirement money to disclose information on compensation and product fees and to develop new systems to track client activity. SIFMA's Ken Benson says it will make smaller retirement accounts too expensive for a lot of firms to manage.
It's going to limit what firms can provide and how they can provide services to those investors and those plan sponsors by adding a tremendous amount of new regulatory and legal liability that firms are going to find very difficult to take on.
If the final rule reads like the initial proposal, its expected cost will keep smaller brokerages from complying, forcing them to either lose accounts or move client money to fee-based rather than commission-based accounts. Accounts SIFMA argues can be more costly. Morningstar forecasts any money lost from the small brokerages will likely find a home in self-directed accounts offered by discount brokers like Charles Schwab, while Credit Suisse forecasts firms offering low-cost exchange-traded funds or ETFs like BlackRock will see more new money coming in. Morgan Stanley, one of the biggest traditional brokers, says it's been prepping for the rule change. It doesn't expect to lose smaller retirement accounts. The Morningstar sees variable annuities like those from Prudential losing favor, as the high fees and added disclosures will discourage advisors from selling them. The pending rule promising changes that will change the world of retirement investing. For Nightly Business Report, I'm Mary Thompson.
Comedian Jerry Seinfeld put his 18 vintage Porsches up for auction today, but many of the top cars missed their low estimates. The big one was this 1973 Can-Am Spyder, estimated to sell between $5 and $7 million. Top bid, $2.8 million. Seinfeld bought it for nearly $4.5 million back in 2012. But this 1955 Spyder did get $5.3 million, topping its $5 million estimate. This could be, Sue, the sign of a first crack in this market.
That's right. I think
when
you're right.
See things like that, art, who knows?
Who knows? We'll be watching it for you, though. That does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching, and we'd like to remind you this is the time of year your public television station seeks your support.